I think now we can get started. We are good to go. So, yep, welcome everyone once again. So, what is Her Tech R? So, we are a group of passionate women coming from diverse background and different part of our stages of our tech career. And we started Her Tech R to just do remote meetups, and we want to empower women. And one of the thing was like so many students are graduating right now, and financial literacy is so important to know, and to know how to invest or to take care, not even just invest, but to take care of your money. So we bring you financial literacy, and today our guests are Aileen and William. So welcome, Aileen and William. Aileen is management consultant at Accenture, and William is uh, account manager at Rockwell Automation. And would you guys people like to introduce yourself, Aileen and William?
Aileen, you want to go first?
Yeah, we actually have an intro slides. So if you want to go through the agenda, and then we can do the introductions.
Sure. So yeah, today we will discuss around the like earning the rights to invest. Then we will discuss around like how to find the truth tellers, retirement plans, and ways of investments like stocks, bonds, ETF, and also talk about credit and side hustles. So stick around and you will get just a lot of things. So yeah, we before we start the introduction, I also want to see how many people who were here are like some of you might be just recent graduates or maybe in the industry already. Like, can someone just introduce themselves and why they are here?
And I have a Menti poll to get that captured.
Oh wow, okay, awesome. So I will stop sharing and it's over to you, Eileen.
Okay.
Thank you.
So let's share my screen. And then let's launch the poll first. If you guys go to menti.com, I don't know how to get rid of this little thingy. If you put code 367852, and then we can kind of get the feel of where is everyone at. I saw some people on the chat that were in New York, Seattle. I'm in Texas. So let's see if people are able to see this. Cincinnati, Houston.
That was me that I put Houston, Aileen.
Of course. El Paso. I'm not answering the poll, but I'm also in the El Paso area. Raleigh. I love Raleigh.
Wow, this is amazing.
Awesome. Do we know how many people we have here? Around 18. So we have 12. So San Jose, we have multiple people in San Jose. Cool. Well, we have a very diverse group, William. I'm excited. So let's jump on to the next question. So we want to know, if you're still in school or if you are a recent grad, how far into your career you are, just kind of to give us some pointers on where to take the conversation. So I am an undergrad or a grad student, or you have 0 to 2 years of experience, 3 to 4, or if you have more than 5 years of experience, that's amazing.
So it looks like we're a lot of recent graduates and 0 to 2 years, but still a good mix. So we can cover a lot of different topics, guys. And as we go through, if you enter or submit questions through a chat, we'll be able to hit them to make sure you guys are getting what you're looking for. Okay, so we can go ahead and do introductions. Hey everyone, so my name is William Gonzalez. I'm an account manager at Rockwell Automation. Before I was an account manager and living here in Houston, Texas, I am originally from Florida, Miami, and lived all over Florida. Went to school in Tampa where I studied industrial engineering. I am the child of 2 immigrants that came from Nicaragua back in '89. So first generation college student. Me and my brothers were all industrial engineers. So we came into the situation of we are now making more money than our parents are making when we became engineers, and my parents' guidance only goes so far. So we started learning more about financial literacy, and now we're learning more and more students aren't aware or don't know where to go. So we started having these conversations. In my spare time, you can see pictures on the bottom that I love to travel. So that's in Colombia. Second one on the bottom is in El Salvador. And the bottom third picture is actually, I do a lot of support with First Robotics. So I was working, or I do work with Mickey Leland, which is a local high school here in Houston. And I support a robotics team that is mainly Hispanic and Black students.
Thanks, Will.
Absolutely.
There you go. So hey everyone, my name's Aileen Tapia. I was born and raised in El Paso, Juarez area. My parents are from Mexico, and I think I have a very unique upbringing just because of living in the border town. I went to school at the University of Texas at El Paso, and just like William, I graduated with my industrial engineering degree. I was very involved with an organization called SHIP, the Society of Hispanic Professional Engineers, in college. So that's the third picture. And then after graduation, I took a solo trip to Spain, which was very interesting. I don't know why I did it, but it was really fun. And that's a picture of Sevilla. It's the Plaza España, which I think it's a beautiful place. If I don't know if any one of you guys have gone to there. And then the bottom picture, when I graduated, I started my journey at Accenture. I moved to Houston, Texas to start that. And that is a picture of me recruiting at the SHIP conference last year. And the last picture, it's a picture with 2 of my mentors. I'm very passionate about women empowerment, so that's why I'm very, very excited about being here and sharing this content that really started from us, you know, not getting the support from our parents, and not because they didn't want to, it's just because they didn't know. We're both first generation students, and so we're very passionate about giving back. So feel free to, I'm not looking at the chat, but I'm sure at the end we can address any of your questions. And so just to start out, this is more of a conversation of financial empowerment. We want to give the resources of what we think you guys should be looking at, starting to take care of your financials. It is very action driven. So we want to provide the resources for you guys to know what you can do with your money, but at the end, it's going to be up to you what actions you want to take in regards to your money. When I started my money journey, it was a lot about the psychological roadblocks that were related to my upbringing. We think about money differently. William has a funny story that I'm not sure if he's going to share, but we're told to just like have our money and put it underneath our mattress and just keep it there. And so with depreciation, you know, that money, it's losing money and not making you money. So thinking about those things of what money conversations we had growing up can impact how we deal with money now. And I like to think about money as a relationship based. I feel comfortable in this group to think about, do you want your relationship with money to be just like a Tinder date, or like a you know, marriage material? So what kind of relationship you want there, as far as, do you just want to go in and out, or do you want something long term? And so I'm hoping it's something more long term, that you want to keep your money growing. And it's very vision driven. And by that, I mean, you know, what's your end goal? And this is going to be very unique to everyone. An end goal for someone might be just, you know, own a house or get rid of all your student debt. And so just know that your financial journey is very unique. And this is something that you shouldn't be comparing to one of your colleagues. You can reach out and, you know, ask questions about what they think, but at the end, it's very personal and it's very unique to your own story.
Yeah, and just to add on that, unique is like the best word that I could describe this as, but this all started with me and Aileen literally just discussing what each of us were doing and getting like feedback from each other on, hey, I'm thinking about doing this. I had this much student debt. These are some of my goals. And then literally just having the conversation out loud and thinking about it is how all of this started for us. So we're thinking the most important thing is for you guys to be aware that it's important and start taking the action that's required. So like those two things I think are the most important thing.
And so one of the things I also want to mention, William moved to Houston before I did. So when I got to Houston, you know, I started with Accenture and they gave me all these benefits, which I'm very grateful for, but I just didn't know what insurance to pick. Given that I was born and raised in the border, it's much cheaper to just go to the doctor in Mexico rather than to go to the doctor in the States. So that's what I used to do. Like, that's what my family used to do. And so when I was talking to William, like, I don't even know what insurance to pick. Like, those conversations are the ones that we're trying to bring more awareness to the table for you guys to not feel the way I felt or the way William felt because we didn't know, you know, who to ask, or we never had these conversations with our families. So that is part of the reason we're happy we're here.
And just to go off of that, me and Aileen had several conversations, and I had told her I actually screwed up on my insurance, and I ended up without insurance my first year of employment. Even though your company offers you insurance and you get like a super discount, I thought I understood what HR had presented to us. I thought I had clicked everything correctly, and turns out that I signed up for a health savings account, but I didn't sign up for actual health insurance. And I had no way of fixing it for a whole year. So I didn't have health insurance for that first year of employment. And growing up, we had like health insurance every now and then for a little bit, and then we wouldn't because times were tough and money was thin for us. So to me, health insurance was just never there, and I never relied on it. But then once I graduated, my mom was like, oh, you're a professional now. You're going to have health insurance. This is awesome. And then my first week on the job, I screwed this up because I didn't understand exactly how to apply and put everything in from what HR explained. So just be aware of that going in and make sure you understand and ask questions. Find the people to ask questions to. Because I made sure Aileen knew, hey, ask them. Don't be scared to sit down with HR and have an hour meeting, just you and them, on getting this approved and making sure you're in the system.
Thanks. So just a very quick slide on what terminology you should do. Assets, the way we define it, and as we just mean me and William, it's anything that puts money in your pocket. Liabilities is anything that takes money out of your pocket. And then if you do a very complicated math, it's asset minus liability. That's your net worth. And so one thing that I just want to mention that I wasn't aware of going into the workforce is the cash flow. So cash flow, it's basically just tracking how much money is coming in and out every month. And if, you know, you're going to get a scholarship, you know, that's going to be part of your cash flow at some point. And so you really want to know where your money is coming from and why you're spending it, basically that money. Yeah, I think that's as much as I want to share on this one, unless you have something, Will.
No, I think I'm good. If you guys have any questions, put them in the chat. I do have the chat open on one of my monitors, so if anything does pop up, we'll make sure to answer it.
Okay, thanks. So we want to start with some other terminology that you guys should consider. Compound interest, it's basically earning interest on interest. And so let's say you have $12,000 invested over 30 years at 8% interest. this is how that chart it's going to look like with compound interest. So this is your initial investment, which is this green part. Simple interest is just earning interest on the initial investment, and then compound interest is basically you're earning interest on both. And so you can see how compound interest, it's in your favor as early on as you can start either investing or having some sort of money in a savings account, high yield savings account. You know, there is a high rate of return that you could have over the period of 30 years or 40 years, however long you want to keep it there. And a fun formula that I like to share, it's the rule of 72. The rule of 72, it's if you can do the math if you want, but it's simplified to how much time is it gonna take for your money to double. And so you take 72 divided by your expected interest rate, an average interest rate that you can take, it's 8%, and that's how much time your money is going to double. So you know, if you have, let's say, I used to do this with like my scholarship money, you know, I'm getting a 2,000 scholarship, what can I do with it? And so if I would have invested it at a specific interest rate, it would have doubled by X amount of years. So that's something. Go.
Just really quick comment on this, Aileen. So for those of you who are just now getting into the workforce, I know we had 6 people who were 0 to 2 years. When you're looking at your 401k, this is like the prime opportunity to invest, because you're probably younger and you're earlier in your career. So you have these, on this chart over here, you have 30 years, and you see how the money becomes bigger and bigger as it gets towards the end. And the companies are going to provide a match. Putting in that match minimum is going to be critical. But I have friends that are putting in 15 and up to, like the most I've heard, which to me, I can't figure out how he does this math, is that he's putting in 28% of his income into his 401k. And he knows that in 30 years, it's going to help him when he's getting ready to retire. So making decisions like that are super important for long-term success. So just keep that in mind when you guys are thinking about investing and your 401ks and whatnot. Go ahead, Emily.
Yep. So we want to talk about 4 different types of investments. So short-term, you know, that's anything from you want to get a new phone, maybe a new computer, maybe you want to take a vacation to, I don't know, you want to go to Miami or something. So that's considered your short term. And then long term, whether you want to buy for a house, maybe you want to save up for a wedding, if you want to save up for a baby, I don't know. Or if you want to go the entrepreneurship route, you know, you want to have capital to fund whatever startup you want to start. We also have the emergency fund, which I have avoided my whole life until I started working, just simply because I couldn't afford it. But basically the emergency fund is saving from 6 to 9 months of expenses in case, you know, you get laid off or, you know, a pandemic that just happened. Without an emergency fund, you might be stressed over your money. And if you have an emergency fund, at least you know that you have some sort of expenses saved in any occasion. Or, I don't know, let's say you have an unexpected visit to the hospital. God willing, that doesn't happen, but we need to be prepared. And then the last one is retirement, which we are going to cover a little bit more when we talk about 401k.
Yeah, and the last comment on those for short term and long term, it's unique to everyone. So your short term might be a long term for me, and my long term might be a short term for you. So this is what we're talking about. Everyone's situation is unique. Go ahead.
Yep. For credit, I want to ask the question to someone who's brave enough to tell us what credit is. If you want to unmute your phone, or if you want to read it off the chat, William.
I don't see anything on the chat yet, but we'll see if we have any volunteers. I think we got another question that has nothing to do with credit, but
Okay.
do you want me to read this or
just,
wait for someone to volunteer for credit?
I want to wait for someone. I want to engage with them, but they're too shy.
We won't move on until we get a volunteer. Credit is free money on interest. Credit might
Free
be how
money
much.
on it.
Yeah, that was free money on interest. Credit might be how much trust you have in making future payments. I like that one.
Okay. Yeah. So basically, credit, it's an agreement between a lender and a borrower in order to the ability to get funds. And so it's kind of on the lines of that second answer. And so, you know, how do you basically put a KPI per se against that trust? And so, well, we come up, or I don't know who came up with it, but we have the credit score for that. And so it's composed of different percentages associated with different attributes. So the first attribute is payment history. And so this is 35% of your overall credit score. It's basically saying if you pay on time or not. And so right now with technology and all of the banks have the functionality for automatic payments, and so you can really take advantage of that so you don't miss a payment. You know, the minimum, if you can pay that, that's fine, but at least me and William have the philosophy of, you know, paying as much as you can, not pay the minimum, because you will be paying that interest over time that it occurs to be a lot of money.
Right. And if you can't, though, I do recommend at the minimum paying the minimum, just because you don't have to pay the full amount to get the payment history checkbox. You just have to make the minimum payment. So just keep that in mind. If you're having a tight month for whatever reason, pandemic hit or family emergency, and just make the minimum payment at the minimum. Well, I can't believe I used the word minimum, but you get the idea.
And so one thing, this is a personal story. I've never missed a payment. And I had in the automatic payment thing, and then I activated the automated payments, but it takes them like 2 cycles to for it to like be active, completely active. And so, you know, I signed up for it and I thought it was good to go. And then I got like a late fee on my credit card. And I was like, hello, like I set up my automatic payments. And so I called, in this case, I called Chase. And I was like, hey, I set up my automatic payments. Like, why am I getting a late fee? It should have been taken care of on its own. And they were like, well, it takes time for it to actually process. But we see that you haven't had a missed payment in like 2 years, so we're just going to waive it for you. And so if it happens that you do miss a payment for whatever reason, you were out of the country, something happened with your family, you can call your lenders, your banks, and try to see if there's anything they can do to help you based on your history. The second attribute is the amounts owed. So out of your entire credit limit that you have, how much money do you actually owe? Hopefully you don't owe more than 30%. 30% is the threshold that they recommend everyone to stay within. I personally like to pay off my credit card instantly. I don't want to feel that I can owe anything to the banks, but that's just at the financial point that I'm at right now. When I was in college, it wasn't the case. When I started working, you know, buying new furniture, buying this for the apartment, moving expenses, like it wasn't what it is right now. But 30%, it's what's recommended of the amount used. And so they call your credit utilization to basically the fraction of how much do you owe divided by your credit limit. Like going backwards. The other 10% is the type of credit. And so very obvious should be the credit cards. It's a type of credit, but your student loans, a mortgage, an auto loan, all of those are still credits, but they have different weights on your credit score. So that is 10%. 15% is the length of your credit history. And so one thing that we recommend when we talk to students is just to open a student credit card. I personally used to use my credit card as a debit card. So if I don't have the money, I don't spend the money. And it was usually, you know, for gas or for my groceries, or, you know, for things that I would expense every single month, but I actually had the money to spend it. And so this is important when you're trying to build your credit, because if you have a very old credit card, it's going to help you with that 15%. And then the last one, it's the new credit. And so if you recently opened a new credit card, or you applied to a new apartment, or I don't know if dorms check, but if you apply for a new apartment, they run your, they run a, what's it called?
Credit score. They run a report on your credit score.
Yeah. And so that's part of your 10%. And so why should I care about my credit score? Your credit score, to me, it's more important than your GPA, because your GPA sits in school, and after you graduate, kind of nobody really talks about it anymore. And your credit score, you need it for almost anything in relation to money.
So whenever you want to do a big investment or start a business, own a property, buy a car, they're going to run your credit. And based off that credit, you'll get a interest rate. Then, like, I never thought this was a big deal until I started talking to my brother, who's a homeowner now. The difference between a 4% interest rate and a 3% interest rate over his 30 years is thousands and thousands of dollars on what he's going to pay back for his loan. And if it's pretty simple to get a good credit score if you know the rules and you're engaged in your credit. But I have friends that never knew the rules, and they just kind of use credit however. They maxed out their credit cards, and their credit score sits in like the 550 to 600 range, which is okay, but it's not like great or good. It's a score, but it's really easy to get up really high and set yourself up for success long term by doing this. So that's the reason we go over this. Does anyone have any questions over credit?
And so I didn't mention this, but the credit score goes from 300 to 850. And there is websites like Credit Karma that give you free credit scores. Most of your credit cards give you monthly free credit scores, and you get one yearly free credit report from one website that we can share. I can't remember the name of it.
No questions, guys?
Do we have questions? No?
Nothing in the chat yet. Okay. So 401ks, I'm just gonna go over this pretty quick. And again, if you have questions, just put them in the chat. So a 401k is a retirement plan that most employers in the US use now. But before the 401k, which is a pension plan, which was, hey, we're going to make a deal between, I'm a company, you're an employee, and if you work here for X amount of years, sometimes it was 10, sometimes it was 15, sometimes it was 20, we're going to pay you for the rest of your life after you retire from our company. And that is how people would retire. So they were very confident in that. Today, that ended back in like 2008. When we went through the first recession, a lot of companies had to pull that back. The government said, we can't allow you to just pull back all pension plans and leave all of these people without a retirement plan. So the 401k is what started being used. And there are two kinds of 401ks. There's a traditional 401k and there's a Roth 401k. The traditional 401k, when you submit the contributions into the 401k, they don't tax it today, and you get taxed when you take the money out. So for example, if I was to put in $10,000 this year into my 401k, for traditional, it would be $10,000, and over the next 30 years, it would gain interest on those $10,000, and it would just continue to grow. So your principal for starting is the full $10,000. If it was a Roth 401k, they take out the taxes today at the rate that you get taxed today. So if I put my $10,000 into my Roth 401k and I get taxed at about 22%, it'll actually be $780. So if you guys do the math, 10,000 versus 780 or 7,800, it will be a smaller number as it goes up. But then you don't pay taxes when you pull it out. So just to go over some of these examples here, scenario one, you have your current tax rates, you're getting taxed at 25%, and the tax rate at 60 years from now at 25% as well. So the tax rates are exactly the same. Every year, or your initial investment is $6,000, and every year you're getting an 8% return. If you go over to the traditional one, you see that your withdrawal amount is $2 million. But because you didn't pay taxes when you put it in, now you have to pay $500K in taxes. So what you're going to receive out of the bank or out of the 401k is $1.5 million. On the Roth side, your whole amount to withdraw became $1.6 million, which is smaller than $2 million, but you pay no taxes because you paid your taxes up front. So in this situation, Roth is more favorable, and you get an extra $100K for retirement. In scenario two, the numbers stay the same, except for your tax rate has now increased. So the way that taxes or 401k/retirement funds work is that you get taxed at the rate either that the government has changed it to. So if taxes go up, you're going to pay more. Or if you are now making more money in retirement than you were when you were younger, you're going to pay more taxes. So it could be one of those two scenarios. So in today's world, it could be either the government raises the taxes or you're making more money in retirement than you were when you were working. So numbers stay the same for the withdrawal amount, but now your withdrawal taxes for the traditional are an additional $200K. So you have $1.3 million, and your Roth stays the same. So the Roth in this situation is favorable, like $300K. And in the situation where traditional is more favorable is when your taxes go down. So you put the amount, you got to your $2 million, and now your tax rate, the government has done a flat tax across the US, and they're charging everyone 15%, doesn't matter. The traditional 401k, the traditional 401k is more favorable by 100K. All of this is to get you guys to think of what you're doing and what you're putting in. I personally am in the thought process of taxes probably aren't going to go down, and I want to make more money as I get older. So I put my money into a Roth 401k, but there are people who do mix. A lot of my coworkers, they do mix. So some will put half of their money into traditional, some of them will put half into Roth. I have coworkers that like traditional because a benefit of traditional is all that money that you're not paying taxes on today comes out of your income when you do your taxes at the end of the year. So if I made 100K and I put 20K into my 401k and I was in a different tax bracket, it would actually bump me down a tax bracket. And now I pay overall less taxes today. So depending on your strategy and how you want to manage this, it could be beneficial to do that. And I've heard friends saying, hey, I want to pay less taxes today because I want my money in my hand today so I can make investments outside of my 401k. So again, this is all to get you guys to think. Are there any questions on the 401ks? This is a high level, pretty quick explanation for 401ks. There are limitations on how much you can invest. I think this year a Roth 401k max is like $19,500 that you can submit into it. So any questions, you guys, gals?
So I want to go back to this slide because we talked about 401k, and so that is only if you have an employer that actually has that benefit, that 401k benefit. If either you're starting your own business or you're a student and you don't have access to a 401k through an employer, there is what it's called the IRA, investment retirement account, and that is through a brokerage account. That's not through an employer. So that's Charles Schwab, Vanguard, Fidelity, all of those brokerage, I don't know how to pronounce it, whatever. Yeah, that you can open an IRA, and they actually do have both options, traditional and Roth. The only limitation with those is that their contribution limits are much lower. I think they're around the 6,000 mark rather than 19 thousands that it's available through the 401k.
I think IRA this year for Roth was 5,500. So every year this will change as the government deems it. So a few years ago, the Roth IRA might have been 4,000, and today it's 5,500. Next year it'll probably be 5,750 or something. So you just look at it, plan out your year, and put the investment in there in hopes of using it when you go into retirement. We got some questions here. How do you prioritize where to put your money first? Roth IRA or 401k, especially if you don't have a match? So for me, I personally like Roth, and IRA comes in Roth, and so does the 401k. I like Roth 401k just because as you move from company to company, you can take it with you. And I'm very like simplistic, where it's like, hey, my money goes here. But if your strategy is to split the money to have it in different investments, then it might be beneficial to do a Roth IRA here and also have a Roth 401k through your employer. There's nothing wrong with that. Just to me, it's more to keep track of. But I have friends that are like, no, this money is for this, and that's why I want to save it there. This money is for another plan, and that's why I want to save it there. So they're already planning 5, 10, 15 years, 20 years down the road for what they want to use this money for. And they're going to let it accrue its own interest. And once it meets that threshold, they're going to use that money. Does that make sense? I'm going to take your side.
The other, I mean, if they typed it, I don't know if they're going to unmute themselves. But I think the other difference from a 401k to an IRA, the 401k, every company does it with a different brokerage firm. And so they have limitations as to what you can invest in, what you can invest in. And the IRA, you basically have more freedom to do it, but that's why it has a lower cap. And so let's say if you cap your IRA, and if you want to invest, a certain percent of your money in retirement accounts, and you already max your IRA, then I would look at, how to maximize your 401k.
Yeah, there is another one question regarding, do you have any inputs on mega backdoor Roth? And there was another one which is like what happens when you move from one company to another about 401k, and how to find the right brokerage. So if you guys can just say, have such.
So I'll speak to moving from company to company. When I was doing my internship, I had no idea what a 401k was. I didn't sign up for it, so they did the automatic, contribution from my paycheck. And so when I, continued doing the internship, I kind of knew more what it was, but I really didn't know where my money was invested. Thank God it was invested somewhere. I've heard stories where they're getting the, they're getting the money taken out of the paycheck, and it's just sitting in the account, but it's not getting invested anywhere. And so make sure that whenever you're setting everything up, you're actually telling the money where it's supposed to go. But when I left that internship, I was able to roll that money into a rollover IRA account. And so basically I said bye to that employer and kept my money and their money, which we haven't talked about vestment periods. Do you want to talk about that, Will?
Yeah. So a vestment period, and each company that has a match has a vestment period, and it changes from company to company. I know of a company that does it immediately. One of my friends, she works at Microsoft, and she said that her investment period is on day one already active. What this means is that their match that they give you is your money once you hit that investment period's mark. For example, Rockwell Automation has a 3-year investment period, and they give us about a 7.5% match per year. So if I put in X dollar, they're also providing the same amount, X dollar. But if I leave before I hit the 3rd year, all the money that they've put in gets taken away, but I get to keep my money in the 401k and take it to another 401k. If I stay and on the 3rd year mark to the day, then I get access to all my money, and now that's my money. If I choose to leave the company, at 3 years and 1 day, I still get to keep all the money that they put in. So that's what the investment period is. So different companies have different rules. For example, there are companies who you get access to your money 20% every year until year 5, and then you get access to everything. So again, read the fine print. And when you're looking at either employers or if you're just now starting at a company, learning about how your match works and how your 401k works for the employer is very valuable. And then
and I think one of the biggest mistakes is that we don't ask enough questions. And so just because you're new to the firm, it's okay to ask those questions to HR or your benefit center, whoever that might be. Because here I was, struggling through finding out what it was and reading through the website, but it would have just been easier if I just pick up the phone and call someone or go to someone's desk. So don't be afraid to do that.
So the next, I think we're good there. The next question was, do you have any inputs on mega backdoor Roth? Which from what I understand, the mega backdoor Roth is that you've already maxed out your company's match and your Roth for the year, and now you would like to continue adding. And I think you can do this, but if you were to do it, just make sure you don't need that money for anything in the near future, because the idea of putting it into a 401k is that you're not going to touch it until you need it for retirement. There are exceptions. For example, what they call life events. So if you're going for higher education, you're buying a house, or if you have a child, and I think the other one is that if somebody dies, you can use it for one of those life situations, life events. You can access that money, and then you need to pay yourself back, and there's penalties if you don't. So as long as you don't need that money at all and you're sure about that, I would be okay with telling someone absolutely put more money into your Roth 401k, especially in your earlier years, so you can achieve your goals long term. Are international students eligible for an IRA? Yes, they are, and I was Googling it just to make sure that they are. And they are. There's an option for. So the initial answer that I have is yes, and that's what and Google just confirmed that. I know that they are. I've never looked into it, so I don't have any more information on that. Aileen, I don't know if you have looked into doing an IRA for an international student while they're here.
No, I'm not sure about IRA. I know it's a yes for a 401k, but I don't have that much information on IRA. They do ask for social security number, that sort of thing. And so if for some reason you don't have a social security, then it might be a no, but I will have to look into it.
Okay, so someone also just commented as, yes, they are. I'm an international student as long as you have a social security number. So exactly with what you're saying, Aileen. And then how do we choose the right brokerage firm for the Roth IRA? So most companies, if you're doing your IRA or your 401k, most companies will provide your brokerage. But if you're doing it independently, I think for me, it's more of support and accessibility. So if you have an office, so like in Houston, there are Charles Schwab offices that you could go in and talk to someone. I personally think that that's good. But some people might be, hey, I want more access on my phone. I want virtual access. I want virtual support. I want someone I can call. So it all depends on what you're looking for and how they're going to support your needs. So I don't want to say, hey, this is the number one brokerage firm and go do that. I actually have a brokerage firm on my phone called Webull, which is kind of like a Robinhood, and they have IRAs. So I've been looking into opening an account through them for an IRA specifically, even though they haven't been around for probably more than 2 years. So I think it all depends on how you want to access it. For me, it's just going to be able to access it on my phone quickly, and I can take a glance. Okay, I don't need anything. Close it. I'm good.
And so just to add on to that, I have actually my rollover IRA with Charles Schwab, and just because I have a checking account with them already. And so it's easy to transfer money to my brokerage account, whether that's my individual one or that's my rollover account. So talking about flexibility, how easily your money can go into that account, I would say.
So investing, in the beginning, we had mentioned that we could go over a bunch of different options for investing. These are the ones that we consider probably the most popular. And I don't know why we don't put the stocks first, but a bond is a deal that you make with either the government or a bank. And the idea is, I'm going to give you $5,000, $10,000, whatever you want to call it. And you're going to double this money. And when I take it out in 7 or 10 years, whatever it is, 20 years, I'm going to have double of that amount of money. Bonds are extremely secure and very safe. They're all insured by the government. So this is a good way to make a long-term investment. I've had friends at work tell me that they've put in a bond for their newborn. So the idea is, hey, I have a child. Let me put in $10,000, and when this child's ready to actually use it, it'll be doubled. Now it'll be $20,000. This might be their first car. This might be tuition for college. This might be whatever that child's going to need when they're older. So that's how my coworkers have used it. I never even thought about it until they mentioned that. And it was like, okay, if I am going to use this money for my child anyways, and I know I'm not going to need it, why not double it before they turn 16, 15, 18 years old? Stock is a individual piece of a company. So a good way that I do this is I trade on Robinhood. You can also trade on other brokerage firms if you'd like. And what it is that I buy a stock for a certain price. And if that price goes up, for example, I'll give an example. I have Kinder Morgan stock. It's a midstream oil and gas company. They move oil and gas for other companies, and their stock is at about $15.50. If I buy that today, and then tomorrow it goes to $16, I can sell that and keep my 50 cents of profit. When you're doing this, there are two kinds of stocks. There's a price stock, which you're investing in it because the price is going to go up, and that's where you're going to make your money. So, for example, Amazon used to be valued dollars, like $5, $10, $20 years ago, 20 years ago, and now it's valued at $2,600. So, if you would have made that investment 20 years ago, call it $100 into Amazon, you would be a millionaire today probably. So that's a price stock. The other kind of stock is a dividend stock. And the idea is I'm going to buy the stock, and every 3 months or every year, depending on how the company does it, we're going to have a dividend where we share our profits with the investors. So for example, that Kinder Morgan stock that I told you about, I have 450 shares of that. Every time that they pay dividends, they give me 1/4 per share. So every time I get paid $115 or so, $110 every quarter for that, owning that stock. It's very stable, and the price doesn't really fluctuate very much. So my goal is just to buy that stock, hold it long term, take that money and reinvest it into the company, so that when I'm older, it's generating me maybe $1,000, $2,000 in dividend every quarter, so I can use that money as I need it for my life, or to keep investing it in stocks or real estate or whichever. A mutual fund is a bucket of stocks. So you take 500 stocks from the stock market, and they take a piece of all of it, so you can own some of everything. So as the market goes up, your money goes up. As the market goes down, your money goes up. The cool thing here is that there's mutual funds and there's also index funds. Mutual fund, when you get dividends, it automatically reinvests it into the mutual fund. So your money just grows. You don't have to really watch it. You just buy the stock, buy the fund, and you just let it go. An index fund, similar to the stock, will pay a dividend, and then the dividend you can use for the purchase of other stock if you want, but it doesn't go back into it doesn't go back into the fund. So you can take that money out, put it in your bank, and then use that to live. So there are people that have $1 million or $2 million in these funds or in stocks. They collect the dividends and they live off of that. So it's a good way to grow your money long term. Real estate, owning property, apartments, complex buildings. The idea is I'm going to rent out property and I'm going to get money for that. That one's pretty straightforward. I think a lot of the younger generation is interested in it. I know I am. That's like one of the goals, to buy a property so I can rent it out. And then an options contract. The idea of here is that you set a price with someone, and you can do this through a brokerage firm, that I'm going to buy your stock at X dollar on this day. If it hits that dollar, you can fulfill that contract. And if it goes above it, you still pay the price here. So just to give you guys an example, if there's a stock worth $10 and I make a contract, hey, I'm going to give you $12 per stock if it goes to $12. but I'm not going to pay you any more. So if it goes past $12, you actually make a profit. So the stock goes to $20 because they released a new technology. You have this contract in place. You get to buy all of those shares for $12 a piece. This is instant profit because you buy the shares, and once you sell that contract, you'll be able to collect $8 per share. So very risky. I avoid contracts, but people will tell me that they love contracts and they're trading a lot of money in contracts. I personally am I am a risky investor, but contracts to me are way too risky. Again, all of this is, hey, look, there are a lot of different options. Figure out what you're interested in, figure out what you like, and make the right decision. But don't take it lightly, and make sure to do your research before you do any of this, guys. The only thing that I want you guys to remember from this is every investment has risk. There is no 100% for sure investment. So you never know. Just make sure you're prepared for any good and bad that might come out of investments.
Yeah. And so this last slide that we have. There you have our LinkedIn QR codes that we forgot to mention in the beginning. There's some podcasts that we like to listen, some books that we have really enjoyed and have helped shape, our financial mindsets, and some of the apps that we actively use during, our daily lives. And so William and I are more welcome to stay. I know we have officially, just 5 more minutes. But some closing thoughts that I want you to think about. It's diversify your mentors just like you would diversify your money. You want to create a board of directors for different things. Maybe you have a career one, you have a professional one, professional development, and academic, if you're still doing your master's. And so, reach out to your peers, reach out to us if you have any other questions. Don't be shy about it. Do your due diligence and educate yourself. Like we said before, everything in investing is a risk. You can be very conservative, like I am, or you can be a little bit more aggressive like William is. And so you can see the both spectrum with having both of us here. And the last thing is to own your worth. The monetary value of how much money you have saved or, in retirement doesn't define your worth. This is just more of, these are the tools that we have used and we have learned over the past, I'm going to say 3 years. So just, take advantage of your network, take advantage of the internet, that there's a lot of information out there. And so I'm just really happy we have had the opportunity to be here at Her Tech Hour. Will, do you have any thoughts?
I think the only nugget that I would want to share is that when Aileen says diversify your mentors and your board of directors, like for me, I never thought that I would be taking financial advice from my boss. And now looking back at it, I'm like, oh my gosh, I should have been asking him questions a long time ago. But we now have like a weekly cadence where we go over work for about 30 minutes, but he is okay to talk with me for 15 minutes once a week on just different investments. And it's a very casual conversation. But when this whole pandemic hit, he had made some comments to me about stocks that he thought were going to come back because they're not really affected by the pandemic. And I was like listening to him, and I went in on a bunch of these stocks and put a bunch of money in, and it came out really well. So now I'm over here thinking, okay, he's actually been watching the stock market for like probably the last 40 years, and he's been working in corporate America for probably close to 40 years. He has a lot of experience. I should be listening to him. But in my head, for whatever reason, a year ago, I would have been like, no, that's a bad idea. Why would I talk to my boss about money? And now I'm like, this is such a good idea. so just be open.
One thing that we didn't start with, William, that we should have. We are not financial advisors. We're not trainer certified. We just want to have this very open and casual conversation with everyone just to spread awareness. But we are not financial advisors. Disclaimer.
Thank you, Aileen and William. Thank you so much. And I think there was one question by Priyanka Hariharan. I think we have only 1 minute. So can you talk about hedge funds and ETF and versus what is ETF? Or yeah, I think it's 1 minute, so that's totally fine.
So I mean, so hedge funds are where you're paying people to manage your money for you, and their job is to make more money for you because they get paid from that profit. So if you are comfortable with that, you can absolutely sign up for that. I think they usually have minimums. So one of my friends, he's a financial advisor, and he told me that his customers need to have $100,000 in cash. So for me, I was obviously not an eligible customer for him, but there are much smaller brokerages that also will support you in that. If you want to give it to somebody else who's professional, absolutely. I've had friends tell me that they've gotten 20% return in a year from a hedge fund manager. The only downside on it is that if they lose money, you still have to pay them. So that's where I would be careful with that and just do your research. And then someone said, can you tell me more about the apps? So on that presentation, that we had 3 apps there. Robinhood, which is a stock brokerage, and you can trade on the New York exchange there. The second one was Mint. Aileen likes to use Mint, and I think you use it to manage all of your expenses and all of your credit card and all your debt. Is that correct, Aileen?
Yeah.
And then
Mint is you basically consolidate, because I have Chase, Discover, Wells Fargo. I have a bunch of application or banks that I use. So Mint basically consolidates everything into one dashboard rather than logging into every single app to, check the status of your money. And so I am one of those persons that William was alluding to, that I have different accounts for different purposes. And so Mint helps me keep track of everything.
Right, and it's all about setting your own strategy. Aileen has that strategy. I'm over here on the opposite end, and I have one account for everything, and I just have a lot going on in my head, and I just keep it in track up here. Probably not a good solution for everyone, but it does work for me, and I'm comfortable with it. And then the last app is called Webull, similar to Robinhood, but I would call it a more advanced version of Robinhood, and they have more information on companies, and they have IRAs that you can set up on Webull. If you don't feel comfortable with the tech companies, and especially because they're new, Fidelity, Charles Schwab, they've been around for probably 50 plus 100 years doing this work, so you could go to those. I am okay with the new up and coming tech companies, and I'm willing to put my money there. So up to you guys.
Awesome.
Any other questions?
I think we are ahead of our time, and we don't want to exceed the time amount. But yeah, this was amazing. We learned a lot, and I think everyone enjoyed. If you guys want to if you people want to reach out to William or Aileen on LinkedIn or even among us, you guys can always. And yeah, this was absolutely amazing to host you, everyone, and thank you so much. Have a good weekend ahead.
That's awesome. Thank you so much for having us.
Bye-bye.
Yeah, thanks for having us.
Bye, everyone.